Warm welcome to another weekend video, guys. This week's video will cover the shortened trading week running from Tuesday the 1st to Friday the 4th of June. The reason why it's a shortened trading week, of course, is due to the observance of Spring Bank holiday in the UK and Memorial Day in the US. So let's jump straight into business then for this week. Our main focus will be firmly set on the US dollar because we do have quite a data heavy week. Starting from Tuesday, we have the ISM manufacturing PMI. Then on Thursday, we have quite a few ADP, national employment, initial jobless claims, and ISM services PMI. And that'll be followed, of course, on Friday with the May NFP jobs report, which will be a very interesting one to keep on the radar. So turning to the US dollar for a second then, the dollar has been on that steady downtrend really from the middle of last year. And recently there's been a few important factors driving this move lower, keeping the dollar pressured. Firstly, of course, there's been Fed policy. The Fed has maintained a very ultra easy policy, especially with that new average inflation targeting regime. They've really turned their focus away from inflation, turning a cold shoulder to the recent moves we've seen, stressing that it will be temporary and transitory, stressing that they will remain or keep that ultra easy policy in place until they see substantial progress being made in the economy. The other key driver for the dollar to the downside, of course, has been that reflationary environment, that expectations for higher growth and higher inflation globally. It's been a key driver really from last year. And the other key driver, of course, in the short term has been that of real yields. Now on this chart, we can see the dollar in red. We can see TIPS inverted in blue, so we use TIPS, the iShares ETF, inverted as a proxy for real yields. And we can just see how closely the US dollar has tracked that move to the downside. Now, what's been interesting though is given the more range-bound price action we've seen recently in things like equities, things like bond yields, things like commodities over the past few weeks, one has to argue that a lot of the reflation expectations have already been reflected in the price. And what that means is that it should become more and more challenging for global growth expectations to continue surprising to the upside. And that would imply that peak reflation downside for the US dollar could be behind us. There might be some room left, of course, to the downside. We don't want to force the market into a particular narrative, but one has to argue that a lot of that negatives in terms of positives from the reflation side, but negative for the dollar, is already reflected in the price. The other one to keep in mind is that US exceptionalism is something that we expect to come back into focus for the US dollar as a positive input for the dollar. Remember, recently we haven't seen growth differentials that highly favors the US economy. We haven't really seen that impact the dollar positively, but that is something that we do think eventually should come back into focus because there has been a massive divergence, of course, in the fiscal impulse between the US and the rest of the world. And that should eventually favor the dollar. Now, what's important though is that we do think that the US exceptionalism, that growth differential advantage, should only come back into focus for the dollar once the market starts to really price in tapering by the Federal Reserve. Now, with this, we do need to keep in mind that the market is always forward looking. And, what we saw from that April Fed minutes and recent comments we've had from dovish members like Vice Chair Clarida saying that they have actually been talking about eventually starting to talk about tape. And that has meant that, we are arguably right now further away from not talking about tapering than we were just a couple of weeks ago. Now, that in itself doesn't mean that the Fed is going to start talking about tapering next week or even next month, but it does mean that the incoming data will be even more important than ever because the markets will use that incoming data as a potential gauge for when the Fed will step up to the plate and start talking about it. Now, the other interesting driver is, of course, like we mentioned, real yields. We saw a lot of pressure to the downside in real yields recently because over the past couple of weeks we've seen inflation expectations 5-year and 10-year, by the way, is these two at the top, and at the bottom we have US 10-year yields. And what we've seen over the last couple of weeks is we've seen as US 10-year yields have been moving range bound, we've seen that continued upside pressure in something like inflation expectations, and that's kept pressure to the downside in real yields, obviously pressuring the US dollar as well. Now, the one thing that's interesting to keep in mind about real yields is that real yields doesn't need Fed tapering to start before we see some upside in real yields. If commodity prices in terms of the CRB index, we've seen some recent movements from China to try and curb the rise of commodity prices. If we start to see commodity prices moving lower, that should impact inflation expectations negatively to the downside. If we start to see inflation expectations outpace US 10-year yields to the downside, then that can also place upside pressure in something like real yield. So it remains a key factor, a key driver that we want to keep a very close eye on for the US dollar, especially in the more short term. So coming then to the week ahead, what can change the US dollar's outlook? It will be any material change in those three factors. So that'll mean real yield starting to move to the upside, the Fed starting to talk about tapering, and of course a little bit of a hiccup in terms of that reflation narrative. So incoming data will be especially important in the upcoming weeks, as the Fed would need to see data continuing to improve to change their policy stance surrounding tapering. And the market will use these incoming data points as a gauge for when the Fed will move forward with their tapering discussions or not. And with this in mind, of course, the main highlight for the week ahead will be the incoming activity data, such as the ISM, services and manufacturing, and then of course that highly anticipated jobs report that we have coming up on Friday. Now for the ISM data, the manufacturing as well as the services data, this will be more in focus in line of the reflation narrative. Markets are trying to establish whether we've potentially reached peak growth in rate of change terms for some of these metrics. Now with both services and manufacturing ISMs reaching multi-decade highs, some participants are expecting some stabilization before these actually start to mean revert to the downside. There has been some recent research coming out from Moody's as well, saying that historically speaking, it's been very, very difficult for something like the ISM manufacturing PMI to stay above that high 60 level. So peak reflation narrative is something that we will see popping up in financial media in the coming weeks. And for that reason, we need to keep a very close eye on these activity measures. Having said that though, all eyes will be on the NFP print, where consensus right now is looking for a print of just over 620,000, coming of course from the low number of 266. Now 266 in itself isn't a low number of course, but if your expectations going into the event is 1 million and you then print at 266, it was quite a low number for the April data. Now what surprised markets the most about that April NFP data was that we saw quite a big divergence in the other labor market data that we had compared to the April NFP print. We saw a solid employment subcomponent print for the ISM PMIs. We also saw that steady downtrend in things like jobless claims, and despite that we had quite a big divergence between actual and expectations for that April print. Now what was interesting, as noted by ING Investment Bank, was that 44% of small businesses reported that they couldn't fill all their job vacancies. Now that highlighted that there is of course a big supply and demand imbalance in the labor market right now. And the reasons for the lack of supply has been attributed to a couple of factors. The first one, of course, is homeschooling. Remember that schools aren't open for business as usual. And that means that there are families where the parents haven't been able to find work that matches up with their daycare times for the kids. And that means that they've had to stay home looking after the kids. But the other one, of course, is health concerns. Some workers are arguably still a little bit hesitant and afraid to go back to work, especially on the services side where you need to work with people every day, due to those risks of getting infected. That's also been touted as one of the reasons. The other one is early retirement. And there has been quite a pickup in people choosing to go on early retirement after the pandemic, which has basically seen a lot less people returning back to the workforce. That's another reason. The biggest one and the most controversial one, of course, has been the increased unemployment benefits. Now, it's been quite a hot topic recently, as the generous unemployment benefits has been touted as one of the key reasons why companies are struggling to find workers to fill their vacancies. There's been some research, of course, done by Wells Fargo and Bank of America pointing out that anyone who previously made less than $34,000 per year would basically receive more from collecting jobless benefits than returning to work. So there are, of course, lots of caveats to this, and it is a very hot topic, especially on the political side of things, as one can imagine. But those four factors has been touted as the real reason why we've seen such a big imbalance between supply and demand in the labor market. So definitely something to keep in mind. Now, a very interesting development in some US states announced a couple of days ago is that some US states will start to phase out some of that pandemic unemployment benefits to basically try and curb some of that potential lack of supply, of course, with people staying at home, choosing rather to receive benefits, being better off that way compared to going back to work. So they are starting to phase out some of these things from June, which means that the incoming June and July jobs reports will arguably even more important than than the May one, because they will be used as a key barometer to see whether the unemployment benefits were one of the big culprits in labor market supply shortages. Now, coming back, of course, to Friday's print, there will, of course, be that initial reaction from the headline print, whether we see another miss or whether we see a beat coming out from that. But we also do need to keep a very, very close eye on any possible revisions coming out from the April data. If we see a substantial upward revision from that 266 number from the prior, if we see a huge upward revision, that could be even more important than just a higher headline print coming out of May. And similarly, a meaningful upward revision in the April data could actually be enough to soften the blow in the event of another miss on the headline for May, because if we see a huge revision, then any lower number we see in May is arguably going to be looked through and says that, okay, we had a huge revision in the April data, we might see a similar revision coming out for the May data. So don't only be focused and fixated on that headline number, also watch that revision. That's arguably going to catch a little bit more attention compared to just the normal headline number coming out for Friday. Whichever way it goes, the incoming jobs prints for this month, as well as June, as well as July, will be key catalysts that the markets will use to try and determine when the Fed will start to discuss tapering and ramp up those discussions. All right, guys, so then looking at a potential trading plan, two scenarios as always, the more bullish outcomes and then the more bearish outcomes. Now, starting with the bullish ones, looking for above maximum expectation prints for the ISM, manufacturing, the ADP, the services, the NFP. Now, do keep in mind that when you look at the ISM, the ADP, and the services, when it comes to the headline numbers, they will of course be important. But in terms of NFP, we want to be looking at that employment subcomponents for the ISM, manufacturing and services as well, because they are key inputs into NFP. So if we see a lot of better than expected prints coming out for the employment subcomponents for the manufacturing and services PMI, that'll increase expectations for a higher NFP print, and vice versa if we see those numbers coming in lower. The other one to watch, of course, for things like the ISM and services is not only the headline and not only the subcomponent in terms of employment, but also the prices paid component. Remember, there's been lots of talk about prices paid and how that is potentially signaling a lot higher print in terms of inflation. So that'll be important not only for the dollar, but also on the yield side of things. Remember that bonds very, very sensitive to any type of inflation news. So maximum prints above the maximum, we'll expect that to see upside in yields. For the US dollar, the caveats that we need to just watch for something like the ISM and services is, remember, we spoke about this in terms of that reflation narrative. If we do start to see better than expected prints, that can actually bode well for the reflation narrative, showing that that peak reflation might not have been reached yet, and that of course can actually be more sanguine on the US dollar instead of being positive. So there is just a little bit of a caveat for the dollar in those two prints, so just pay attention to that. And then of course, turning to the bearish outcomes, the exact opposite, but also the same for the US dollar. If we do see PMIs printing below minimum expectations, that could actually be negative for the dollar from a knee-jerk reaction. But if that starts to doubt or add fuel to the fire that we might have reached peak reflation, then that can actually start to be more positive for the US dollar. So we just need to keep that caveat in mind for those two ISM prints in terms of the headline and how that might affect the US dollar. And then again, looking at those subcomponents for things like prices paid, for yields, and of course the employment as it affects NFP forecasts going into Friday. All right, guys, so that is everything from our side for this week ahead video. We do hope you guys have a fantastic trading week ahead. And as always, if there's any questions, don't hesitate to let us know.